session, we will discuss the core principle of IFRS 7 financial instruments disclosure. We will specifically deal with why IFRS 7 exists and what it attempts to achieve when it comes to disclosure in the financial statements. Now, IFRS 7 provides disclosure requirements, and when I talk about disclosure requirements, I refer to what we need to tell the users in the notes to the financial statements regarding financial instruments. Now, financial instruments include our financial assets, our financial liabilities, and those instruments that we use for hedging purposes. So it's all our financial instruments that we, as discussed in IAS 32, and also what we've discussed in Ifrs 9. So this brings everything together for reporting purposes and disclosure purposes. So why is IFRS 7 so important? If we just go a step back and we look at this sentence where we say we need to tell the users of the financial statement about the entity's financial instruments. And why is that important? Now, IFRS 7 gives us two reasons why this is important for the users of the financial statements. They need to understand what the impact of the financial instruments are on the statement of financial position. So we need to disclose in the notes how the statement of financial position has been impacted by the financial instruments. And in addition to that, where those financial instruments affected our statement of profit or loss and other comprehensive income, we need to tell them what that impact is. So these are the financial impacts of financial instruments on your statement of financial position and your statement of profit or loss and other comprehensive income. But the standards or disclosure of accounting has changed dramatically. Where we usually were very focused on giving the quantitative effects, so the amounts, to disclose the effect in amounts or currency units, let it be rand or pound or euro, to give the effect, we've now moved also to a greater focus on qualitative disclosure. So telling me a bit more about the instrument or the item, the accounting item in words. And this is where number 2 is very important. Financial instruments expose the company to various risks, and we need to tell the users about those risks, the type of risk that the user is exposed to, and also the amount of those risks. So where in currency is the effect allocated of these risks. And in addition to that, and this is very important in terms of the conceptual framework, how does management manage those risks? So the stewardship principle, and we'll look at that now in the next slide. So 1, tell me about the impact of the financial instruments on my financial statements, and I will show that in the notes or on the face where the standard allows me to do that. And then secondly, tell me about the risk, the amounts of those risks, and how the entity managed those risks. Now, just let's stop at risk, because this is a line that runs right through financial instruments disclosure. It's all about the risk, telling the users how the company is impacted by this. So a financial instrument is exposed to which risk? It's exposed to credit risk. So the risk, for instance, that the other party will default on its obligations. So, for instance, you have a trade receivable. The credit risk is that the debtor or the trade receivable will not meet their commitment and pay you the outstanding amount. So that's the credit risk. We also have liquidity risk. So Do you have enough cash available to pay your debtors, to pay your creditors, your liabilities? We also have market risk, very important, where we deal with interest rate risk, currency risk, and all the other price risks that are included in market risk. So financial instruments are exposed to various risks and we have to disclose it. But management has an obligation to manage this risk, and we need to tell the users how we did this. Why is this important? Because if you look in the conceptual framework, the objective of general purpose financial reporting is to provide useful information. Now, if you look further into what useful means in terms of the conceptual framework, it means that you have to tell the user how the company managed its resources that it obtained through equity, so through its shareholders contributing capital to the company. What did they do with that capital? What did they do with those resources, and how did they manage it? So if they've received capital, how did they expend it? How did they protect it? How did they manage it? And we need to disclose that. In terms of financial instruments, the company used its resources to either purchase or obtain or acquire a financial assets, and how did they manage those financial assets and protect it from risk. And that is the core principle behind Ifrs 7. Please join me in the next sessions where we will discuss in more detail Ifrs 7 financial instruments disclosure.